Hey, and how are you? Scott.hinson with LP2 Realty back with you here. Last week, I uploaded a longer video, long for my channel anyway, with John Dillon with CMG Home Loans. Focused mainly on the home funded program, and we talked about some other things in the middle and latter part of the video. This one program called the All-in-One, my fear was it may have gotten lost in that earlier video. So I've pulled this portion out for you. If you don't have to be a high income earner, your income needs to be sufficient that you well outpace, shall I say, your monthly expenses. Again, I'm going to leave this to John to get into the details, and you contact him to talk about it. But it's a different way to manage your money, folks, and I encourage you to give this a listen. Liquidity, all those kinds of things come into play, but a great product from CMG Home Loans. Here's John. You touched on first-time home buyers a little bit. We can, maybe over time pull that out a little bit more and do some more. But how about let's just switch gears totally here, and maybe you're all-in-one for a different segment.
Sure. The all-in-one, actually had a conversation with a client about it today. And the all-in-one, for the right client, is the absolute best loan program on the market, period, end of story. It's the best one that we offer. It's the best one that I've heard anybody offering. And what the all-in-one is the all-in-one ties in all of your finances that revolve through the equity that you have in your house. What it is, it's a first lien home equity line. It's an interest-only loan. And what it does is when you get paid, you can take your paychecks and you deposit them into this sweep away checking account. So let's say you have a $300,000 mortgage balance and you make $15,000 a month. That money, when you deposit into the account, is going to sweep away and immediately pay down the principal in your home. It's the only principal first loan program on the market that I've ever heard of. And what that means is that when you do that over time, you're compounding how much more you're paying down in principal and how much less you're paying in interest. Because it's month to month, it's essentially re-amortizing the loan every single month. So after you pay down $15,000 into your mortgage balance and your new balance is $285, you might have $5,000 worth of expenses and it goes back up to $290. But the next month, when you get paid again, now all of a sudden you're down to $275. You pay $5,000 more in bills and whatnot. You're at $280. You paid $15,000 now. Again, you're at $265. And over 3 months, hypothetically speaking, you've paid $35,000 off of the principal that you own in your home. It's a revolutionary program. It is not meant for everybody. People who are, trying to get by every month, it's not something that I would suggest, because it's for people who have a lot of additional money that they're saving up month over month. They might be accruing, $30,000 or $40,000 in a checking account that's earning no interest, whereas that money could be used to pay down their principal balance on their mortgage. And now all of a sudden, they're saving whatever the interest rate is. It's a month-to-month adjustable. So it's
if you have, say, self-employed, they've got a business that cash flows great, it's stable, and even though those expenses each month come through, they're managed well. Is that something does this have to be personal, or can it be split out as business, personal? Does any of that impact this?
Absolutely. So it's great for people who are self-employed. One of the biggest reasons is self-employed people have to do their own taxes. They get paid a 1099 for the most part, and then they're taxed at the end of the year. And what you're doing is you're taking all of that money that you have available that you're making, and you're paying down the principal balance. You have access with a checkbook and with a debit card at any given moment, you could go to the grocery store and swipe that debit card and pay with the equity you have in your house. Obviously, it takes a responsible person, but the beauty of it is that, you know, you might not get paid. You might not get paid 1 month, and all it's going to do is add that interest only payment to it. You don't have to worry about going into default if you can't make a payment 1 month. If you make, you know, if you get paid once every 3 months, but it's a large sum of money, you can take that whole amount and pay down significantly more than what you've owed on your mortgage for those interest only payments. And then at the end of the year, the tax benefit is that you've built up all of this equity in your home. You can pay out your taxes or your insurance because they're not escrowed through the program. And at one time, use the equity that you've gained in your house to pay for those things off. And it just, you know, it's 3 steps forward and 1 step back, essentially.
So I'm hearing that the timeline to potentially pay off one's mortgage in this program might be significantly shorter than just the traditional 30-year mortgage.
Absolutely. It's going to be significantly fat for the right client. And I'll flat out tell people, you know, at a certain point, this might be right for you. Right now, I don't believe that it is right for you. But with all that said, you know, for the right client, I've seen somebody that could pay off a $750,000 house in 1.5 years.
How many?
And that's in 1.5 years.
Oh my gosh.
And what that's doing is now all of a sudden they're sitting on an equity line for about $600,000 that they can use whenever they would like, but all they're getting charged is $250 a year to keep the account open. And now they have this equity line, all this financial freedom. If they wanted to go buy an investment property, they could pay it for an investment property with cash, with the equity that they have in their home, and rinse and repeat it.
That's why me as a realtor am wanting to talk about this program, because that gives the option for people to go out and get that second home, vacation home, investment properties. You can come talk to me. But to start this process, you need to go see John. You need to talk to John and let him, again, lay it all out, discuss your options. And but that's